Welcome to Business Exit Success, the podcast dedicated to helping small business owners on how they can successfully transition out of their business on their terms while also living a life of purpose and fulfillment after the sale. I am your host, certified financial planner and certified exit planning advisor, Tom Poltersdorf. Taxes are likely to be the largest expense you will have throughout your entire life. In this video, I will explain 7 ways to minimize taxes as a business owner, so let's dive in. First is hiring your kids. If you own a business and have kids under the age of 18, you can pay them $13,850 tax-free in 2023 and deduct it from your taxable income. Hiring your child as an employee is a business expense, and you can deduct the wages paid to your child from your taxable income, lowering your tax liability as long as they are performing work-related tasks in your business. Tasks can include administrative work, managing your social media, or other age-appropriate responsibilities. Your child will owe 0 in taxes as long as the wages are under the individual standard deduction limit, which is $13,850 for 2023. This leaves a tremendous opportunity to invest $6,500 of that income into a Roth IRA, which then grows tax-free and has the potential to be taken out tax-free again down the road. The second way is using the Augusta Rule. This allows homeowners to rent out their home for up to 14 days per year without having to pay tax on rental income. If you own a business, you can host a team retreat, party, event, or meeting at your home and rent it out to your own business as long as it's for legitimate business purposes. The rental expense is deductible by the business and the rental income is non-taxable if the home is rented out for less than 15 days. If you do decide to do this, make sure to maintain good records, invoice the business, issue a 1099 from the business to the homeowner, keep good notes, and document the business purpose or the meeting. Here's an example. Let's say you rent your home for $500 a night for 14 days and have your corporation pay $7,000 for the use, which ends up being a $7,000 deduction to your business, and you pay no tax on the money personally. This reduces your taxable income and also offers tax-free income from the rent. The third way to save on taxes is using the Section 179 tax deduction. This allows business owners to write off the entire cost of a vehicle used for work, cars, trucks, SUVs, etc. For tax years beginning in 2023, the maximum 179 expense deduction is $1,160,000. So if your business acquires equipment between January 1st to December 31st, and you use it more than 50% of the time before the end of the year, you can deduct this under Section 179. Keep in mind, if the equipment you are looking at takes a few months to deliver, plan ahead so you can make sure it's available before the deadline. Next are business expenses. One of the greatest things about being a business owner is you can claim a ton of deductions that salaried employees cannot, such as travel, supplies, marketing and advertising, home office costs, rent, internet, health insurance, and education. And I want to highlight education because investing in your employees is essential, especially if you are looking to one day exit and sell your business. You'll need the business to not have to depend on you to function, meaning you'll need a reliable team to back you up. So paying for classes, workshops, seminars, designations for your employees to help support their growth path within your business can all be deductible. Just make sure to keep accurate financial records throughout the year. Number 5 is the primary residence exclusion, Section 121, which is not just limited to business owners. Anybody can use this tax strategy here. Homeowners can exclude $250,000 of capital gains from the sale of their home and up to $500,000 if married. If you sell your primary residence for a profit, you don't pay taxes on the gain up to those amounts. For example, if you're married and bought a house for $300,000 and you end up selling it for $800,000, you make a $500,000 profit on the sale. That $500,000 is completely tax-free. Just make sure you pass the ownership and the use test here, which states you're eligible for the exclusion if you have owned and used your home as your main home for a period of at least 2 years out of the last 5 years prior to the date of sale. The sixth way to save on taxes are 401k retirement contributions. As both the employer and employee, you can make contributions from both the perspectives, allowing you to contribute up to $66,000 annually in pre-tax income. This leads to significant tax deductions and offers flexibility in many different investment options depending on the plan. As an employee, you can contribute up to $22,500 for 2023. As the employer, you can contribute up to 25% of your profit, allowing for a combined contribution of up to $66,000. Investment options can include stocks, bonds, crypto, real estate, or private equity, so a lot of flexibility there. Number 7 is being aware that there are states in the US with no state income tax. So depending on which state you live in, you can save on taxes. There are 9 states that do not have a state income tax, and I'll put those up here for you. They include New Hampshire, South Dakota, Washington, Tennessee, Wyoming, Nevada, Florida, Alaska, and Texas. Lastly, remember to run any of these strategies by your accountant and CPA. This is meant to be for educational purposes only, so do your homework and take advantage if you can. Hey everybody, real quick before you take off, if you found this episode helpful in any way, please rate the podcast and leave a review. I would love to get your feedback and see if there are any topics you'd like to hear more about going forward. Thank you, and I appreciate you all very much.